All right, folks, Dave here, and today we're tackling a titan, Amazon, ticker AMZN. This stock has seen some interesting moves lately, leaving many wondering, is Amazon a buy? Well, we've crunched the numbers, pored over the charts, and I'm ready to spill the beans on what our deep dive analysis reveals. So, what's the buzz around Amazon right now? The market narrative is pretty clear. It's all about efficiency and strategic growth. We've seen headlines, like the one about their recent corporate layoffs. Remember that Yahoo Finance article? While layoffs sound tough, the market is actually interpreting these moves as Amazon's commitment to operational leverage and trimming the fat. They're showing they can grow their operating income faster than their revenue, which is a big deal for profitability. Key drivers like Amazon Web Services, or AWS, and their booming advertising services continue to be the darlings of Wall Street. Essentially, investors are looking for Amazon to be leaner, meaner, and more profitable. For anyone new to the channel, let's quickly recap what Amazon.com, Inc. actually does. Beyond being the online shopping behemoth we all know and love, Amazon is a diversified powerhouse. They sell everything from merchandise to subscriptions through their online and physical stores, they're big into third-party sellers, and they manufacture popular electronic devices like Kindles and Echoes. But here's the kicker. Their big moneymakers are increasingly Amazon Web Services, that's their cloud computing arm, and their massive advertising business. They also serve consumers, sellers, developers, and enterprises globally, offering everything from storage to machine learning services. Management's guidance, which our analysis takes into account, suggests a focus on sustained earnings growth, projecting healthy EPS increases over the next 5 years. Now, let's get into the meat and potatoes, our multi-scenario analysis. How do we reconcile this market narrative of efficiency with Amazon's stated goals? Well, the corporate layoffs and focus on operating leverage perfectly align with the company's objective to drive profitability alongside growth. It's not just about selling more, it's about making more money from every sale and every service. This is key to understanding our scenarios. First up, the base case. This is where we see Amazon continuing its current path. Solid, moderate revenue growth, but with significant improvements in operating leverage and efficiency. Think of it like this. They're not just running faster, they're running smarter. AWS and advertising keep chugging along as strong growth engines. The recent layoffs aren't just one-offs. They signal ongoing cost discipline, which expands margins. We're looking at current EPS of $6.55, and we're projecting next year's EPS to grow by about 18.84%, hitting $7.78. When we slap a slightly elevated forward PE multiple of 33 on that, reflecting positive sentiment on their efficiency gains, we get a fair value of $256.74. We're giving this base case a 50% probability. Why? Because technically, AMZN is sitting right on a critical multi-week support level at $212. This suggests that while a dip isn't impossible, a stabilization or a bounce towards this base case fair value is the more likely immediate path, keeping us out of a rapid bear market scenario for now. Next, let's peek at the bull case. This is where everything goes better than expected. We're talking a stronger economic recovery, consumers opening their wallets wider for e-commerce, and AWS absolutely skyrocketing thanks to increased enterprise cloud adoption and a surge in new AI workloads. Advertising revenue would explode, and all those efficiency initiatives, like the layoffs, would yield even bigger operating leverage and margin expansion than anticipated. We'd see EPS growth accelerate to 25% for next year, taking us to $8.19. Apply a more optimistic forward PE of 38, and boom, we're looking at a fair value of $311.22. Now, we're assigning this bull case a 30% probability. Why not higher? Well, technically, while the fundamentals support significant upside, the stock is currently at support, not showing a clear breakout. To hit this bull case, we'd need a definitive break above the 236 consolidation range and then the 243 resistance level, which would require stronger catalysts than we're seeing right now. And finally, we have to consider the bear case. This is our what if things go south scenario. Imagine a deeper, prolonged economic slowdown hitting consumer spending and e-commerce hard. AWS growth could decelerate further than expected as companies cut IT budgets even more aggressively. Advertising revenue would take a big hit from reduced corporate marketing. The benefits from cost-cutting would be completely overshadowed by plummeting demand, squeezing those margins. Our EPS growth would slow significantly to just 10% next year, bringing EPS to $7.21. With increased risk and slower growth, the market would assign a lower PE, say 28, giving us a fair value of $201.88. We're giving this bear case a 20% probability. The technicals are key here. The stock is currently on support at $212. If that support fails and we see a breakdown with the next support identified around $195, then this bear case becomes much more probable. It's a credible risk if that buying interest at current levels doesn't materialize. All right, let's pull up the chart. Here's what I'm seeing based on our technical analysis. AMZN has been in a pretty clear multi-week consolidation range, bouncing between 236 on the high side and 212 on the low side. Right now, it's sitting right on that 212 support level. This is a critical point. If we see a breakdown below this 212 mark, our next key support level to watch out for is around $195. On the flip side, if AMZN can rally and break out of this consolidation, the upside resistance we'll be eyeing is at $243. So it's currently at a pivotal juncture on the charts. So is AMZN a buy? After weighing all the evidence, the probability-weighted average fair value comes in at approximately $257.48. This suggests moderate upside from the current price. While the technicals show AMZN sitting right on a critical support, making the bear case a real risk if that support fails, the fundamental story of improving profitability and strong growth drivers in AWS and advertising, especially with ongoing efficiency initiatives, leans towards a base case or even bull case outcome. My verdict? The bottom might be in for the short term, but we're in a consolidation phase. The downside is contained by strong support, while significant upside will require clear catalysts to push past resistance. It's a cautiously optimistic outlook, with defined risks. Based on our analysis, if you're looking to scale into AMZN, the current support around $212 offers a compelling entry point, aligning with the low end of our base case potential. Should we see a dip towards the bear case, the next technical support around $195 would present an even stronger accumulation zone. For those with a longer horizon, looking at our base case fair value of $256.74 and our bull case fair value of $311.22, these levels represent potential targets once the stock breaks out of its current consolidation. All right, that's a wrap on AMZN. If you found this breakdown helpful, do me a favor, smash that like button, subscribe to the channel if you haven't already, and hit the notification bell so you don't miss our next deep dive. And tell me in the comments below, what do you think about Amazon? Is the bottom in for real? Let me know. Now remember folks, this is not financial advice. I'm just a guy with a microphone and a lot of analysis. All investments carry risk, and you could lose money. Always do your own due diligence and consult with a qualified financial advisor before making any investment decisions. This content is for informational and educational purposes only.